Good morning, folks. Happy Taco Tuesday to all those who celebrate this momentous occasion, getting a bit of a bid as we prepare for Back to the Futures with me, Markets and Mayhem, this Tuesday, April 22nd. What a lot has been transpiring just all around. It's really been pretty incredible to watch everything. So I've got some pretty interesting slides to share with you all this morning. I'm excited about that. And then we're going to dive into Bookmap and look at some of the flows and some of the trading setups that may be presenting themselves today. We'll also be looking at some of the options flow in the S&P 500 and some of the more popular optionable stocks. So give me one moment. I'm just going to put an announcement out there real quick about this, and then we'll hit this event. It'll be fun. All right, folks, it is time for this week's episode of Back to the Futures with me, Markets and Mayhem, presenting on behalf of Bookmap, talking a little bit about what's going on in this much more volatile trading environment that we're in now. This is a lot different than what folks may have been used to in 2024 and 2023, but this is an environment where we really have to adjust to the new normal. What used to work doesn't work anymore, and there's nothing wrong with that, but it does mean that we're best served adapting to this new reality. There's no use in fighting it. No use in reflexively just buying the Mag 7 dips. We know that's not working. We know that the narrative there has changed quite a bit. So we're in a different world, one where opportunity exists in more of the safe havens. We see gold hitting all-time highs. We see some of the high dividend stocks continuing to hold up and show resilience versus the broader market. And in those flows, there is opportunity. Now, quick disclosure, be sure to manage your risk in an environment like this even more carefully than you usually do. If you don't have risk management practices carved out, this is a great time to start practicing them now, because you probably won't survive this market if you don't manage your risk. And what I mean by that is, don't put into a trade any more than you're willing to lose, and be aware that in a lower liquidity environment, you're going to have much more potential for face rippers and big dips, and they can happen in short time frames. That means smaller size and wider stops. Folks at Bookmap would love for you to join them on their Discord. Check out discord.com/invite/bookmap. There's regular educational events and a lot more. And I was just basically given some information here about verification. You have to register your email at bookmap.com by April 26th, so that's coming right up. And if you're not registered yet, it is free. Visit discord.gg/bookmap to visit their Discord and make sure to register your email address. I'm there every Tuesday at 9 a.m. for Back to the Futures. A bit about me. I've been trading for about 20 years. It's been an incredible journey, and it's one where you're always able to learn more. That's one of the things about trading that I'm actually very grateful about. It's the idea that there's really always something left to learn. And I think for any of us that are intellectually hungry, which is a very healthy state to be, trading suits you, right? It suits me for that reason specifically because it always keeps me on my toes. There's always something to learn. Like with this new regime we're in, this is an opportunity to see what's working and what's not. And a lot of trading systems that people were using are not working anymore. And while there's nothing wrong with that, it does mean that it's time to update, it's time to adapt, it's time to evolve. So let's talk a little bit about order flow here, why I watch it in particular. The big part of order flow analysis that I think deserves the most attention is what we call the deltas or the differentials. A lot of tools that analyze order flow focus on these, including some of mine. And you can do this through tools. You could also do it manually, but these deltas tell you a story of aggression. When there's a large sell delta or buy delta, it gives you a sense as to which party is getting more aggressive. And we'll look at this on the Bookmap heat map and in some of those charts with some live examples throughout today's trading session. Another area to watch, icebergs. And this is something that you can get pretty good clarity on, in the sense that now we're able to see in the order flow where these icebergs are transacting. And that gives us a sense, especially if they're larger icebergs, as to where these larger institutional desks may be showing interest in de-risking, putting on shorts, getting long, etc. And if it's large enough of an order, it can mark a turning point as well. So watching those deltas, watching those icebergs from some of the larger trading desks, and then also watching exhaustive trading action. Exhaustion isn't common. That is to say, you're not going to see an exhaustion indicator pop up every 2 minutes. But when there is a big enough event, exhaustion plays out. Typically, it's one side getting way too ahead of themselves. Maybe buyers are just absolutely sweeping the order book. And, that spread crossing and the size of it and it versus some of what we've seen in the tape prior gives us a sense that they're getting a little bit drunk. They're getting a little bit too aggressive, and that can lead to exhaustion, which may make for a turning point, particularly if you start to layer some of this information in. Let's say you have an exhaustion print. I have an exhaustion indicator I've added to Bookmap. And in that exhaustion print, you also see some icebergs coming in. So maybe it's a buyer exhaustion, and then you start to see sell icebergs coming in. That can give you a sense that you may be on the precipice of a reversal. So watching the flow, watching for extremes, watching for what may start to indicate there's a key area of interest or there's a turning point coming up. That's one of the key elements of order flow that helps, particularly if you come into your trading day ready. And what I mean is you already know where your risk and reward levels are. You already have a sense as to how you're going to plot out the price action, and you're ready to trade the tape 3 ways: up, down, or sideways. Now, I prefer trend days more than mean reversion or sideways consolidation days, but there is trading opportunities in all 3 environments. If you look at it as a 3-way auction, trend days give you an opportunity to buy dips and keep running that market higher. When it's an upward trend day, when it's a downward trend day, you get the opportunity to sell rips and continue covering into weakness. And in a consolidation day, you get an opportunity to kind of play ping pong with price if you're into that sort of thing. Let's look at a couple charts. NVIDIA looks like it's set for another trend test. I don't like this chart at all. I do think that there's some potential it could try to get to that trend line again and hold up, but this chart looks real heavy. We're below the 21 weak moving average, which is a pretty big momentum indicator to slip under. We're also in the Ichimoku cloud, which gives you a sense that we're not in any kind of a trend right now, but we're tempting breaking below that cloud and retesting that trend line. All this happening while the MACD histogram is showing pretty nasty downward momentum. And we could, if we cut below that trend line, get into this real low volume area where price action could get much more volatile for NVIDIA. The story behind NVIDIA, the AI narrative, is also slowly but surely becoming upended. There's a lot of changes that are happening in the world of AI. And unfortunately for NVIDIA, that's not really priced in to their overall story right now, in my opinion. I think NVIDIA has to reckon with the AI CapEx story becoming upended. And the implications for that is really that their growth story is upended as well. So what does that mean? It means it's likely that this bear action in NVIDIA is far from over. If you think about what's driving it, you've got more efficient AI models. In fact, Google just released a 4-bit model with some level of quantization awareness that performs like a 16-bit model. I was trying it last night. It's their latest Gemma 27 billion parameter model. It's actually quite good. And you also see inference becoming more efficient. So it's not just the models, it's the way we interact with them. You've got K and V caching, speculative decoding, and other technologies that significantly accelerates inference. Training is becoming more efficient. The chips, the hardware used for training and inference are becoming more specialized and moving away from NVIDIA's general purpose GPUs as well. So this is all negative. These are all also, interestingly, events that I talked about likely playing out this year, and I identified them last summer for Trader Aid members on one of our updates, providing some research of risks that were growing in AI, and particularly NVIDIA. And now we see them crystallizing. And then the cherry on top is going to be that big reduction in AI CapEx that we already see happening. Microsoft's making noises, Amazon's making noises, Google's moving away from NVIDIA GPUs to their own TPU technology. So the writing is on the wall. I think this thing breaks. And unfortunately, I think it gives a lot of those gains from last year back because the story is no longer intact. And that growth that made its rich valuation possible is likely to be upended. Well, let's take a look at Apple. Apple rejected this trend reversal attempt pretty violently, and it looks like it's set to continue making lower lows here. It is now back in this high volume node. We can see there was this attempt when it made the low to break out of that high volume node. It got into this low volume node. It touched the cloud, neutralized the downtrend briefly, but sellers overpowered that move, brought us back into this high volume node and under the cloud with MACD histogram momentum deeply negative. So Apple looks quite nasty here. I think it's still destined for lower lows before all is said and done. I'm going to look down here around $160 or lower for another area of where I may get interested in a potential bounce. And gold is just absolutely going parabolic. It's pretty incredible to see what's happening in gold right now. Now, I look at gold as an uncertainty hedge. So if you look at it through that lens, uncertainty is absolutely, unforgivingly skyrocketing to new, never before seen heights. And you can see that not just in gold, but in policy uncertainty measures, as well as the Goldman Vol Panic Index. There's a lot of things that are making new all-time highs that, in no uncertain terms, suggest really high levels of uncertainty. And that's not a stock market's friend. But it is a friend of gold. To a lesser extent, it's a friend of silver and some of the better quality miners in this space. I do think gold is getting a little crowded short term. Just the short-term traders have piled into it. It's in everyone's, inboxes. It's all over the news, and it's just going up, up, and away. I don't like parabolic moves. The way that gold had been moving up to this point, where it was sort of rally, consolidate, rally, consolidate, rally, consolidate, that was healthy. This move is getting a little more scary in the sense that every time I see gold have a really big parabolic move, eventually it ends really badly, and a lot of that big parabolic move is reversed. So I'm personally hoping that we get some consolidation or correction because I am still bullish of gold. But if this move continues to just ramp higher like this, I'm going to get a little bit more concerned about the potential for a disorderly unwind of gold prices. And market momentum in the S&P 500 continues to favor sellers here. We can see nasty rejections at that 21-day moving average over and over, but also lower highs and lower lows. This is a pattern, and we're likely to make our next lower low next. I'm looking for around 4,600 on the S&P for that next lower low. I don't think that's going to be the low, but I think that's around where we see the next lower low. We're nowhere near out of the woods on this, folks. I'm sorry to be the voice of sobriety and reason in a market that has been punch drunk and just absolutely loving irrational levels of multiple expansion. But the frothiness is behind us because the AI narrative is being upended. The government spending supporting this market is slowing, and the upper class of consumers, the top 10% that accounted for about 50% of consumption trends, they're checking out due to negative wealth effects. They're looking at those broker statements and saying, oh boy, I'm not going to spend as much. And this all has negative effects on economic data, but also on earnings. So I think we're going to start to see some of that in the guidance. I think this earnings season aren't going to be as big of a problem looking back to Q1 as what we hear from companies looking forward. Now, we are back deep in negative gamma once again. This is a market that is very illiquid and very deep in negative gamma with a lot of room for it to move all over the map intraday. So again, that's why it's super important to be nimble. You have to consider widening your stops and reducing your size and being way more careful about what you're trading, because this is a market that can absolutely destroy you in seconds if you're on the wrong side of a trade or you just have too much size and you get shaken out by that volatility. Because again, about 500 points, over 500 points in a negative gamma. That's deep. It's not as deep as we've been. We've been over 800 points, but it's deep enough that when you look at the way this market is trading and the sort of chaos in that daily tape that can happen, those wicks that can move way more than you want to see them move in a 5-minute time frame, that's giving you a sense that you have to be more careful. Yes, yesterday was orderly in the selling, but that doesn't mean that during all that transacting, you're not going to see higher levels of volatility in the tape, and we are. It's also interesting to note because realized volatility is close to 50% while the VIX is close to 30. Volatility is still cheap here, believe it or not. Let's talk about some of the key levels going into today. These are the key options levels. We have 6,000 as the call wall, 5691 as the gamma flip, 5,000 is the put wall, and 5,000 is the vol trigger. Needless to say, 5,000 is a really big level. I believe we'll see some support down there as well. So, ultimately looking for this lower low to take us to 4,600, but I think we'll get stuck around 5,000 for a little bit, may provide some support. Certainly a big magnetic level to watch. Then we also have today's pivots. This is a bullish above, bearish below pivots. We can see right now S&P is having a nice little run. I try to share these every day on the TraderA Discord. They've been very actionable. They're based on looking at price action and order flow over varying time periods. And then I add some algorithmic nuance to that, and it helps to come up with actionable price points. So in today's tape, we're looking at being pretty bullish here overall to enter the session, given the pre-market, but also these pivots. So I'm just posting that out on social. If you're looking for those pivots, you can find them there. And then really quickly, got some awesome deals going on. If you'd like to check out Bookmap, you can get up to 40%. That's 40% off. Visit TraderA.com/bookmap. That's a really solid deal. Scroll down to the special offers. And then if you'd like to check out what we're doing at TraderAid, for a limited time, we're offering 20% off. Use the code Mayhem20 at checkout. So visit TraderAid.com, learn more about us. If you'd like to see what we're up to, check out our awesome trading tools, including the SPX options visualizer, the dynamic pivots, our exhaustion and absorption indicators, our unusual options activity, and more. Visit TraderAid.com and use that code Mayhem20 at checkout. And now we're going to go right into Bookmap and take a look at what's going on around the markets here. We did mention the S&P futures, so I feel it's probably fair to start there. You can see overnight, pretty much a flat session with a dip, and now we're starting to see some pretty aggressive buying. And we talked about deltas earlier. That's one of the ways we analyze order flow. Well, you can see there's a pretty healthy sized delta buy bubble there, and it was relatively unfazed by some passive selling, 150 lot iceberg just on top. So let's zoom in just a little bit to that price action, and we can see where there was that transacting. The volume bars on the bottom are also delta. So this is some pretty aggressive attempt by the buyers to just push price higher, try to take control of the tape. Some passive selling came in. That's led us to some consolidation here. But overall, I'm looking for this to be a day where we may get some upside volatility instead. This is a market that does want to rally, on any kind of positive catalyst. It doesn't mean we're out of the woods. Again, I still think we're in a bear market. I still think lower lows are to come. But you also have to be aware every day, regardless of what the broader market regime is, it's a three-way tape, up, down, or sideways. And we need to recalibrate ourselves to try to take advantage of those opportunities as they present themselves. So seeing that ramp into the close yesterday and some of that order flow that's likely still to be completed may give us some continuation. Let's see what the market brings us when we open at 9:30. That being said, if we do get a sizable pop today, I think it's likely to be one of those pops that one can consider fading. I still believe in selling the rips, raising cash, hedging, or taking tactical shorts into rallies, because I think that the trend is pretty clear, as we talked about in those charts, down. We're still going down. And while I'm bullish of equities over the long run, and I'm making a shopping list and I'm doing deep research on companies I want to own for the long term, I'm still of the mind that without any clarity or certainty about policy, and with all this escalation and back and forth, we still have a market that doesn't really know what's happening. And the market doesn't like that. It doesn't like uncertainty. Uncertainty is a volatility catalyst, and volatility tends to lead to de-risking. And that's the environment we're in. Now, folks, I want to hear from you. If you have any questions for me about anything or any charts you'd like me to cover, let me know. We're just about 9 minutes away from the market open here. Should be a fun trading day. So when I say fading, that's trader vernacular for taking a short position, basically selling into a move. It doesn't necessarily just have to be short. You could be long and fade a rally, because you're getting out of that risk. But typically fading a move is talking about shorting something. All right, we've got some requests coming in, Palantir among them. Let me pull this up first on TrendSpider here. So Palantir, just full disclosure, I've been long this thing with a cost basis of about $7. When we had these insane moves higher, especially above $100, and the valuation started to get pretty insane, I was selling calls into that, which ended up being pretty helpful to reduce my cost basis and also hedge out some of that risk. So I will say with Palantir, just from a structural perspective, long term, zooming out, I'm still bullish on this thing. I'm just not thrilled about its valuation because the valuation is kind of egregious, right? You're talking about a company that's trading at about 131 forward PE. It's trading about 74 times sales. So it's extremely expensive here. I'm still a seller of calls into strength on Palantir simply because I think that's the smart move when it's trading at these types of frothy heights. And if I get called out of my shares, I'm okay with that. I'll sell puts at lower strikes where I'm okay getting some of those shares put back in my portfolio and just sort of harvesting that premium the whole time to reduce my cost basis. So that all being said, Palantir has been remarkably resilient into what has been a de-risking of the AI narrative and also just big tech in general. And I think there are some reasons for that. I think one reason that Palantir has been more resilient comes down to the fact that it is not tied to the same narrative that we've seen NVIDIA, Microsoft, Google, Meta, and others tied to. And by the way, Meta's Llama 4 AI model is totally horrible. They really dropped the ball on it. It's no wonder they were so worried about DeepSeek. But Palantir is different because their AI is targeting enterprise use cases, data analytics, automation, and really full information awareness across multiple different disparate silos, harmonizing that and providing actionable analytics. It's not a chatbot. It's not a large language model centric AI like some of these others that require enormous amounts of GPUs. And so that differentiates them. They also have one of the few AI SaaS offerings that is profitable and has been and has solid margins. So I think that differentiates them from the overall AI story. Now, looking at the chart, we can see pretty clearly the uptrend is still intact. We're above the Ichimoku cloud. We're above the 21-week moving average. We may get a bit stuck in this high volume node up here, only because that's where we've seen folks really like to transact. And we can see a lot of that chunkiness of the trading, despite this errant move higher that was pretty quickly corrected, has us in this range, a range that's between about 70 and 90 bucks a share. So I think that's one thing to keep in mind. We do still see a lot of interest in upside in Palantir. Calls are still looking for $100 a share, and it's certainly possible that we could see that in the stock. But I will caution, I am very bullish of Palantir long term, but I do think that, like everything else, it does face an increased set of risks in this environment, particularly due to its valuation and the potential for a greater economic contraction. So I wouldn't want to be piling in here and now. If I was looking to buy Palantir and I didn't have any exposure, I'd be looking to sell puts around strikes where I'd be comfortable having shares put into my portfolio. That's my quick and dirty on Palantir. And as the trading day gets started, I will also look at it in the order book because I think it could be a pretty fun one to watch. So let me go ahead and add it and backfill about 6 hours of history there too. And then Dan, if I don't get to it, just remind me because I'd love to look at this one today during the trading day as well. Got some other questions coming in. So I got a comment in the YouTube saying, Jem Carson liked the comment I posted on your X saying the market was going to rip soon. Yeah, I mean, look, at the end of the day, we have to be aware that bear market rallies are the most unforgiving, brutal, shocking moves to the upside that you can possibly imagine. One of the best examples of that recently was that reversal on tariffs that led to over 10% upside in the S&P, much of that playing out in a few minutes. That's one reason you can't get too cute with size or conviction in a market like this because anything can change at any time. So, we do have that upside risk in an environment like this because the market wants to rally, but it needs positive catalysts. And without that, it's tempted to just simply move sideways to lower. On the other side of it, powerful negative catalysts can pull this market a great deal lower. Now, why am I taking both sides of that? Let me show you. Let me show you quite simply what I'm talking about. So here's the order book for the S&P 500, and we're going to use a plugin that's called Outside Liquidity, and that plugin shows you how deep the order book is. Okay, the order book is showing you all the interest in different prices across the S&P 500 futures contract. Right now, there's only 23,000 orders, limit orders placed on the S&P 500 order book. That's a very thin book. Now, obviously, it may thicken up a bit as we get into the trading day, but really anything under 50,000 is pretty illiquid. And we're at half that, or less than half that going into today. This is a very illiquid tape. We'll see what shapes up in about a minute and a half when the market opens. But to me, that tells me it takes a lot less to push price. If you've got less liquidity, less participation, that means that the same amount of order flow that might have moved price 0.5% in a 50K deep book might move price over 1% in a book like this. It's just something to think about. So Big Deal Donuts, my trade right now that has been my favorite trade in this environment has been long SPHD. That's the S&P 500 high dividend defensive large caps, and short SPHB. That's the S&P 500 large cap high beta stocks. So in an environment like this, you've got money managers fleeing high beta and growth and other more cyclical stocks and piling into high dividend defensives. A lot of money management is long only. They can't just go to cash or bonds or whatever. They've got to be long only in stocks. And so what do you do in an environment where you think the economy could go into a recession and where risk is rising, but you can't sell all your stocks? Well, you rotate into safer parts of the market and you dump the unsafe stuff. That long SPHD, short SPHB trade capitalizes on both parts of that rotation. And it's beating the market by about 30% year to date. The S&P is down about 10%. Long SPHD, short SPHB is up about 20%. So that's a delta of 30% outperformance versus the broader S&P. But what's even more interesting, this trade performs like volatility, like the VIX. So it gives you that kind of exposure, but without the premium decay and without the complexity of managing that type of a trade. Markets are open now. We're getting just a little bit more buyer aggression into that open. See that in that large delta bubble here, but maybe not set to last. Seeing some sellers coming in, making their presence known as the point of controls pulled up just a little higher here at the opening bell. And I'm just going to pull up my options monitoring tool here too. Take a look at what's going on in those flows as they come through some of the single stocks. And oh boy, we've got Tesla earnings tonight, so that should be fun. The last earnings call was basically pure incoherence and hype, and yet it was overall well received. Let's see if this time is the same. I don't know that investors are going to be quite as giddy and patient. All right, let's continue to look around some of these questions. What about NVIDIA? So, Madhur, if you want to rewind the video, I covered NVIDIA pretty extensively, including the chart, the AI narrative, and everything. But my long and short of it is I don't think that they're in a good spot. I think the risks outweigh the potential for rewards here for NVIDIA because the entire AI narrative is being upended. So maybe rewind a bit, check out that NVIDIA chart. I talk a lot about what's going on with NVIDIA right now, but needless to say, I think it's one to be careful of. Short term, you might get some good trades out of it, but I think the overall narrative that powered a lot of the gains is behind it for now. Jorge asks, what do you think about Reddit and Robinhood? So I'm happy to pull up some charts on those, and I'm happy to pull up charts on NVIDIA too, just, so we have a little bit of everything here. Here's that NVIDIA chart just so I can show you really quickly. I posted this earlier in the stream, but it doesn't look good. It looks like it's ready to retest that trend line. It's below the 21 week. It's below the it's trading in the Ichimoku cloud, tempting a move below. And the MACD histogram is deeply negative. Everything about this chart screams heavy. So maybe we get a little bit of a touch and maybe we put in a lower high, but I think we're headed to lower lows on NVIDIA. Last time I had a price target on this thing, it was 90, hit that and then some. Now, based on the way this chart is looking, sadly, if that 90 level doesn't hold on a weekly closing basis, we could really be looking at getting to this lower end of the volume profile, which shockingly goes down to between $40 and $50 a share. I know that sounds crazy, but we're not in the market we used to be in. So I think that's something to just be aware of in this environment that we're in right now. Give me 1 second. All right. It's looking like I'm going to have to quickly restart, just running into a technical glitch here. So give me a moment, folks. I apologize for the interruption. I will be right back. All right, folks. Sorry about that. A little bit of a technical snafu. These things happen, but I should be back. If you have any issues, let me know. Just checking on everything and making sure it's all good. And I'll be getting back to some of these questions here. Just give me one moment as I get everything sorted out. But yeah, we are seeing just a little bit of a pop here, back off the opening low. So that's encouraging on the S&P 500 futures, as you can see on screen. And seeing a little bit more of a push here now. We're making a break above the 52.49.50 pivot. That's constructive. You see some passive sellers trying to layer in, but doesn't seem to be having much of an effect. You know, we saw that a little earlier on the tape, but also passive buyers seem to be coming in with a little bit more size here. And let's get back to some of the questions that folks have. So Reddit and Robinhood. Yep, let me pull up some charts here. I'm going to tell you though, my own 2 cents on these is that it's a dangerous game right now. because the biggest reason these things had the kind of strength that they did was the presumption of really strong growth trends. And a lot of that is challenged, right? So Reddit's really just a website that sells advertising. Like if we're being completely transparent about what Reddit's business model is, it just sells ads, right? And they're very expensive here, in my opinion. But it's not even just a one guy's opinion type of thing. Let's look at the Reddit fundamentals real quick. Reddit is trading at a forward PE of 43. Average for a NASDAQ stock like this should be around 2025. It's trading at 13 times sales. So it's still a bit expensive. I do like that they don't really have any debt to be concerned about. I do like that they're showing promising growth trends. But I think that the way this stock has kind of given back all of that enormous run post IPO tells us a little bit of a story, right? It's also one of insider selling because we are past that period where insider selling is restricted. So you see, if you look at the Reddit sales, and I'll just pull this on screen real quick, there's a lot of selling going on here. So I'm not really a fan right now. I think this thing can get cheaper. I do see, looking at the chart here, it's broken this sort of structural trend that it had on the weekly. So for me, Reddit is one that I'd be more interested in, probably if it bases around, say, 50 bucks or so, which sounds crazy, but it's not. It's really not. What's crazy is how much it moved on how little expansion of its fundamentals in a healthy way. So now we're seeing true price discovery coming back to the stock, and I still think it could go quite a bit lower. But down there around, 40, 50 bucks, I would consider buying this thing. Maybe even around 60 if it bases there. I would consider buying it. It's just a little bit frothy for me here, and momentum continues to favor the sellers. And looking at Robinhood's got kind of a similar look to it. It's not quite as bad as Reddit's chart. Still got that overall weekly momentum somewhat intact, but it's challenging that 21-week moving average. MACD is pulling lower, and it's kind of getting stuck in this high volume node. But the bigger thing about Hood is it's predicated on, folks like us, retail, having plenty of capital to trade and trading often. I'm not so sure that we're in an environment where that's going to go really well. What I mean is that a lot of negative wealth effects are blowing up people's portfolios that got cute with leverage. You've got folks that also have to, really consider working again because this whole trading thing isn't working out as well. I mean, 95% of people that try to become traders don't succeed. And a market like this is what brings about that realization. When the regime changes quickly and a lot of people get blown up, when the old strategies that used to work don't work anymore, but people keep doubling down stubbornly. So I think Robinhood has some structural challenges because its client base may not be as active in the quarters ahead. I would be really interested to hear what they have to say about that on earnings. The biggest boon to Robinhood right now is probably the resilience in crypto. But nevertheless, this is a company where I still think it is kind of frothy. Let's take a look at the valuation. Trading at a forward PE of 25, so not terribly expensive, but a little rich in the current environment. Also trading at about 12 times sales. That is rich. So, I like Hood better than I like Reddit here. If I had to choose one of the two, I would choose Hood. But I don't know that they're out of their respective hardship either because their key client base, us, retail, could be challenged here for a bit. Let's get a look back at the markets here. S&P continuing to rally, getting that push higher. And now we're challenging the 52.62 major pivot level. This is one of the major pivot levels that my dynamic pivots indicator produced. We're seeing some resistance there, but pushing above here would open us up to some pretty significant upside. So we are seeing that push. We talked about it pre-market that we were looking for some bullishness because we're trading above some of these key pivot levels. We talked about yesterday's order flow into the close having some potential for continuation. We're seeing that all play out in this morning's tape. Ship says, teacher, what would some of your shopping lists be based on the market now for a day trader? So, I mean, for me, a shopping list is for investing. So I'm not really making a day trader shopping list. Like I'm making a shopping list of companies I want to buy and hold for 5 or 10 years. And that includes companies like UPS. It includes companies like SAIC. It includes companies like AMD. There's a whole bunch we share on the Discord of investing ideas, particularly when they're challenged. When these companies are getting beaten down, but their long-term picture is still strong, those are the kind of companies that I like to buy, and I nibble. I don't make huge bets and say, "Oh, this is it. This is the bottom. This is," that's how you hurt yourself. I nibble. I nibble and I build positions dollar cost averaging into these things over time because that's how true wealth is built. Buying great companies at great prices over time. And bear markets can be an amazing way to jumpstart that journey. So I'm asked, do I think deep value microcaps can finally have a comeback in this market? I am sorry to say that ship has sailed. That was a 2021 ship. And in this market, that whole area is going to be even more challenged because a lot of those companies, they have trouble raising capital and they're not profitable. So if they're not making money, and they can't just go to a bank and get a loan, or they get a loan at prevailing rates that are very high and they revolve based on wherever the Fed is, that's problematic. On the other side, they can go and dilute shareholders by issuing common stock and issuing convertibles, which is also problematic. So there's really not a lot that gets me excited about that area because it's not a forgiving environment. Those stocks tend to do better when we're at zero interest rates, when liquidity is abundant, when concerns about debt and growth are pushed out into the future. So I don't think this is the best place for microcaps right now. Now, obviously, there's going to be exceptions to every rule. There's going to be some of those stocks that find their path to profitability, that grow into small caps and maybe even mid caps, but those are going to be the outliers in an environment like this. And I'm asked, has anything Elon promised ever happened? Yeah, here and there, but those are edge cases. They're not the baseline. So there's there's things here and there that he said that have come true eventually, but by and large, he's a hype man. And sadly, Jensen Huang of Nvidia has become very similar to that. A lot of the prognostications he's been making are wildly optimistic and not rooted in reality. Mark Zuckerberg of Meta has also become that way with the way he's hyped up Llama and their AI initiatives, and yet really not finding strong ROI there or return on investment. And Llama 4 is probably the worst model I've seen them create given where everything else is right now. I mean, you've got companies with a fraction of the resources creating far superior, smaller models. Alibaba's QWQ32B is an example of that. And also Google and Gemma. Gemma 327 billion is a great model, especially with its new format that allows it to have the quality of a 16-bit model, but only 4 bits of actual depth, which gives it a lot lower size in your video memory, meaning I can run it on my home computer. So a lot of promises in that whole area are largely nonsensical, but that doesn't mean that we don't have some real progress happening in AI. There is real progress happening in efficiency, in the way we're building models, in the way we're training them, and in some of the processes that we're using to infer those models to interact with them. So, the AI story is real, but now it's shifted gears from an arms race to who has the most GPUs, which obviously doesn't give you a competitive advantage if you look at what's happening at Meta. Now it's a arms race about who can be the most efficient and build the best technology on the software side. We're seeing call activity pick up. The hot call, the most active strike on the S&P 500 options chain, transacting 2,000 contracts there. And that really is looking interesting. There's some confluence with ES 5300 as well. So it looks like options flow is telling us we have some room to move higher here. There is interest in higher prices. This is a lot different than the options flow we had yesterday. Yesterday until late in the day, that flow was just targeting 5,100 aggressively, and we pretty much kissed that level and then didn't look back, moving higher into the close. Now, today's tape is a bit the opposite. Options so far, at least, looking for higher prices. And 5,300 ES showing some pretty solid interest. Yeah, I discussed NASDAQ 100 J Global. Anything you'd like to talk about in particular there? I mean, the NASDAQ 100 is basically the high beta cousin of the S&P 500. It's significantly lower liquidity. So look at the order book on the NASDAQ, it's less than 6,000 versus the S&P 500 right now is about 24,000. So that's pretty significant that it's about, a quarter of the S&P's depth, which is one of the reasons it doesn't take much to move this thing all over the map. I don't look at the NASDAQ quite as much because of its extraordinarily high beta, but also because the options in NDX and Triple Q aren't nearly as meaningful as SPX options and the relationship they have with ES. So SPX options trade about 1.2 trillion of notional a day, and that's more than any other optionable instrument by far. And if you look at just the notional futures flow in ES, it's about 350 billion a day. So the tail really does wag the dog. We don't have that with QQQ versus NQ. It's not quite the same relationship. So I like to look at ES a little more because the systems that I've built tend to help me map out probabilistic outcomes with greater certainty than NQ. Doesn't mean I don't trade NQ or Triple Q or the tech stocks, but tend to focus more on ES for that reason because the options are the market. And never before, like basically over the last 3 years or so, never before have they been as important as they are now. But I do think the NASDAQ 100 is important. It's a momentum indicator, and it's also a factor indicator. NASDAQ is full of tech and growth and more of that sort of longer duration risk cofactor. So that's an area that I watch also for relative strength versus weakness. And obviously the NASDAQ's shown a lot of relative weakness versus the broader market this year, which is a story of de-risking out of the Mag 7. Got about 6 minutes left, folks. If you're interested in learning more about what I'm up to at TraderAid, visit traderaid.com. You can use the code Mayhem20 for a limited time to get 20% off on our subscriptions to our Discord. We have all of our trading tools and a variety of awesome analysis, ideas, and a great community of people. Also, if you're interested in checking out Bookmap, visit traderaid.com/bookmap. That's traderaid.com/bookmap. Scroll down to the special offers and get up to 40% off. It's a pretty big deal for your first billing period. And if you have questions for me and you're watching the stream later or I'm not able to get to them during the stream, feel free to reach out by email. My email is mayhem@traderaid.com. That's mayhem@traderaid.com. And we are seeing a bit of a rejection up there at that 52.62 pivot level on ES. So we popped above it, but we didn't really build much acceptance. We did have a bit of a stop run, 271 contracts stopped out to the upside. So those are largely shorts getting stopped out. Minor exhaustion, you could call it, because again, 24K order book depth. That's nothing. That's so light. There's just barely anyone participating in this market. I still think, however, we do have more interest to the upside here. So we may consolidate only to make another break higher. Let's take a look at some of the mega caps here before we wrap up the stream for the week. I will be back tonight, by the way. We're going to cover Tesla earnings live, which I am really looking forward to because I think it's going to be hilarious. But yeah, tune in for that as well. I'll probably get the stream back online in the afternoon ahead of earnings. And I'm just re-alphabetizing all this stuff because it's one of the things that I like to do. So let's take a look at these mega cap stocks. Apple off the open here. Largely consolidating, really not a lot of decisiveness. A bit of a bid initially and then just sideways. You've got a lot of interest in higher prices on Apple, a little bit of lopsided order book, delta of 2 million favoring offers over bids, and those really big offers. 198, 199, but especially 200 with about 99,000 shares on offer there for AAPL. Amazon, let's zoom this out a little bit as well. Pop after the open, now just sort of consolidating and similar, a lot of interest in higher prices, but a bit of a lopsided order book. 1.1 million on offer versus bids. Broadcom, kind of a similar look to it overall. We're just going to zoom that out as much as we can. It looks like it didn't backfill that data, so I'll see if I can get back to that. But essentially a very similar look and a bit of a delta towards the offers, 1.2 million. So you can see with Broadcom actually sold at the open and is now climbing back towards its point of control. Alphabet, big offer overhead at 150, about 15,000 shares on offer there. And this one's pretty evenly matched on the order book. Meta's got a little bit more offer than bid, but not by much. Really big offer overhead, could provide some resistance around 500. And Microsoft chopping sideways after a pop on the open, now just dropping lower and consolidating that. MicroStrategy, the sort of preferred high beta vehicle for some folks that like trading this sort of nonsense. And it's largely trading sideways, but it did make a new high. It had a sort of powerful open here off the low. You see a lot of buying happening. Then there's this absorption event as it got to 340. You saw shares start to fall. That offer disappeared for a bit. It is back up there, and we see some interest in pushing back up there. And Delta favors offers by about 489,000. You have NVIDIA. A lot of interest in higher prices, but you've got to zoom out a little bit to really see that interest. 120 and 130 have some pretty chunky offers, over a million at 120. And that delta also is a pretty heavy order book, 18 million to the sell side versus the buy side. And we've got Tesla earnings coming tonight, some buying in anticipation of those earnings. We can see the stock making new highs, pretty evenly matched order book, lots of interest up there at 240. So, folks, that is going to wrap it up for this week's edition of Back to the Futures with me, Markets and Mayhem. I hope you've enjoyed this. I've certainly enjoyed presenting it. I enjoy it every week. I'll be back next week, Tuesday at 9 a.m. Eastern. And be sure to tune in later today for Tesla's earnings call. I'll be covering all the Mag 7 stocks and some of the other big earnings events